So the exam window opened up this week, right? And it's not due till, is it due this Sunday or
No, it's not due until like the 12th.
December?
Yeah.
Exam 3. That gives me plenty of time then. On the accounting stuff, have you started it yet? Okay.
So we're gonna like some modes and stuff.
What I'm gonna do is do the examples in each chapter and just like tie that into the company. So I literally just.
Yeah.
That's the only thing. How's it going?
Hey, pretty good. How are you?
It's good.
Good Thanksgiving.
Yeah, did you?
Yeah.
Ate lots of turkey. That's for sure.
Eat too much turkey, drank too much beer, the whole 9 yards.
Yeah.
The usual.
Genie pumpkin pie.
Yeah, I was
Yeah.
ready to detox by the time we got done with it.
You only have 2 weeks. The end is fast approaching.
I know it.
It's so shocking.
We're gonna be talking about that a little bit tonight, so.
Is exam 3, is that due the 12th?
Yeah,
Okay.
I just posted it today.
Great.
So the syllabus shows tonight's the night for exam 3, and I opened the window and you'll have 2 weeks.
Now on the project for each appendix section for each chapter,
Yeah,
you're mainly looking for application for our company, right? Like, so if I'm following the example videos, is that pretty near what you're looking for in terms of application?
yeah, and it won't always apply.
Okay, right, because there has been some stuff where it's like,
Yeah, if it's not applicable, just say, my company doesn't have any leases. So
Okay.
there wasn't any analysis to do on lease accounting.
in the footnotes, for example, I was looking at last night, the statutory tax rate was like 21%, but they didn't really talk about the state tax when I was looking at trying to determine the cost of debt.
There's no mention of state.
I didn't see it
taxes
at all
anywhere
in the 10K. I didn't see it.
Okay, well, there's.
I did a proxy for like, so what I looked at the Demoter and like WAC for the industry. I kind of did that as a proxy, but I was able to find a cost of equity, obviously, with the CAPM. So I kind of talked about the difference there with the industry CAPM and then for the industry cost of equity.
Okay, yeah, no problem.
Okay.
If it's not mentioned in the 10K, then it's likely immaterial.
Okay, great.
You could go search for it, but I'm not gonna hold you accountable to that. It's beyond the scope of this class.
Yeah, because ATO just updated their 10K like a few days ago for this, because their fiscal year ended.
Well, don't feel like you have to use that 10K filing if they just updated it.
Okay.
Whatever they had released in the past will be fine.
Okay. Okay.
In the real world, your boss would tell you differently, but you'll get the same benefit.
Okay.
Zoom crew, somebody chime in and let me know you have sound. I cannot hear you. If you can hear me. Let's see here. Okay, I got chat. Okay, you can hear everything. Great. Thanks, Sam. Appreciate it. So if I got communication via chat, and if you can hear me, we are good. It is 5:30, so we will get started.
Recording in progress.
Okay, I'm getting some feedback, so if you have a question, great. If not, go ahead and put yourself on mute and we'll get going. Okay, happy Thanksgiving. Welcome back. It's been a couple of weeks. If you're anything like me, you kind of have to remind yourself where we were before we took off for break. And that was very quickly coming up on the third exam. We had just finished all of the modules leading up through module 12, which means that the third exam is now open. I opened it today, so you can go out there and take that anytime in the next 2 weeks. So it will close on December the 12th. And then you will have until the end of the semester to get your research project. Now, the semester ends on December the 16th. So that would be the Friday. There's that research project being on the 12th also. But if you need a couple more days, I can give you a couple more days. Even say that, because if I tell you I'm going to give you a couple more days, everybody's going to take a couple more days, which is not good for me, because these are not easy to grade. And I get down to the Friday the 16th of December, and I think grades are due the following Monday. It's not easy for me to grade all these, but as my 14-year-old daughter says, that sounds like a you problem. So just get it to me as soon as you can. If you can get it to me by the 12th, that's terrific. Earlier in the semester.
When the next exam is due, have you already?
Yeah, but let's cover it again, because everybody needs to know that. I just opened it today.
Okay.
So you can go out there today and take it, and I left it open for 2 weeks. So it'll close, that's December the 12th at midnight. Anytime in that stretch, anytime in that window, take the exam. Let me know if you have any technical difficulties. I'll help you troubleshoot. Research project to do also during that time. This is the last week to take me up on my offer that I made earlier in the semester, giving you feedback in advance of that research project being done. If you get it to me this week, I can give you feedback on what you would need to get an A on that research project. I know the way the end of the semester goes. You all got finals and you're cramming to get everything in. I can probably count on one hand how many students have taken me up on that offer in the last 5 years. So no problem. That's the Vernon Cushenberry School of graduating from your master's program. Put it all up until the end. Graduate with a very solid 3.2 GPA. No employer will ever look at it. I'm joking, but there's a kernel of truth there. Okay, so we got exam. We have exam. We have research project. I want to talk about the research project tonight, and then I want to go into module 13, but only briefly.
More question on the quizzes.
Yeah.
We still to continue doing those homework quizzes through the end of all the modules?
The homework continues to the end of all the modules. So module 13, 14, 15 would each be worth 10 points. So there's 30 points for you to go take those module quizzes as many times as you want, just like normal homework. So that's how I quote unquote test. Those aren't tests, those are just homework. But that's how I gauge your grasp of that material in this class. There's no final exam, there's no comprehensive exam, there's no test over modules 13, 14, 15. I'm just gonna let the homework serve that purpose and then integrate that into the research project. And we're gonna talk about that a little bit tonight, because primarily that material addresses the financial side of this class, which is the basic valuation equation of coming to the conclusion about what these companies are worth.
We deviate some from like the normal book way to value. Is that okay? Like I do cash flow yield analysis or something like that.
Well, yes, it's okay, but it needs to be in addition to, because I need to see you do a discounted cash flow analysis, which I'm going to talk about first thing tonight. And I also need to see you do a multiple analysis relative to peers and relative to a company's own history. And those are very, very simple. That's my very first topic of conversation in that. I want to make sure everybody knows how to use the cover page of our research report, which is supposed to look like this. I need it to look like this. If it doesn't look like this, you'll get a B. As that's your ceiling. You can only go to a B if it doesn't look like this. Because I only have 3 days to grade all this. So one of my grading hacks is that they all have to look the same. Because I can go through these a lot more quickly when they all look the same. And I think you'll find that when you get, a job working for a mutual fund company, that's what your boss wants to see too.
So when you say look like this, the example that you sent out that you bragged about in terms of being the best you've always had looks similar to that, but not exactly like that.
Yeah, there are some, here, I'll just pull that up. Thank you for drawing my attention to that. Our attention to that. Here's that Qualcomm report that was very well done that I use as an example, and you'll see that the formatting looks very, very similar. But if I scroll down here, well, let's see. Okay, there they are side by side. You can see, well, it's nearly identical. What distinction were you drawing there?
Maybe it's a formatting thing on the one that you said, like the second column.
Yeah, maybe it is a formatting thing. And there's a video out on our YouTube site that will teach you how to merge PDF documents so that you can get the formatting as close as you can possibly get it. If you're in Excel and you go File, Print, there will be an option that pops up to save as PDF. And then you've saved this cover page as a PDF file. You do the same thing with the Word document, File, Print, you can go save as PDF. Now you have a PDF of your cover page, which was previously an Excel file. And you have a PDF of the rest of your document, which was previously the Word file. And then you can merge those. And there's a lot of free utilities on the internet that just merge those right together, which is how this report was created.
So if ours looks like that, that's
terrific. Yes, that's fantastic. And you get there by using this Excel file, which is available on Canvas. I'll blow that up a little bit and let's just talk about that. Is this page, remember how these research reports are supposed to look. This page is supposed to give me everything that I need to know in the most concise and salient manner. So we have the beginnings of what is the company? What do they do? I want you to hit the highlights of the management team, the 4 M's, management, moat, mispricing, and mark. You're going to give me a couple of sentences, make them as hard-hitting as you can, make them meaningful. You don't have time to give me the names and biographies of all 9 board members on the cover page. Tell me what I need to know about management team. Top-notch management team, highly invested, great track record, terrific at generating returns for shareholders. You're not necessarily speaking in full sentences. That's where the art of drafting a research report comes in, because you have to be quick and concise with your communication. So give me a good cover page. Hit on all 4 of those. This profile is easy. You can copy and cut this from Yahoo Finance or MSN or Bloomberg or Morningstar or what have you. It might not necessarily fit. Feel free to condense it, take some liberties. give me the information that I need to understand what the company does. And then you'll notice there's a stock and financial data section. So shares outstanding, market cap, daily volume. As a portfolio manager, you need to know this stuff. And average daily volume, if I'm a portfolio manager and you're an analyst working for me, I need to know that this stock trades in sufficient volume to warrant a purchase that would be meaningful for our shareholders, something that would move the needle. So 52-week range, short interest, percent foreign sales, net insider shares sold in the last 6 months. You should be able to get this off most financial websites too. I want to know if there's been any recent insider buying or selling. Okay. Then there's a section on there for risks and challenges. Hopefully at this point in the semester, you've already identified the biggest risks to these companies. And then valuation ratios. You can calculate these valuation ratios yourself. I mentioned there's a variety of valuation techniques that you can use. Some of the parts, bankruptcy, Altman Z-score, those are all supplementary. What I need to see at a minimum is the discounted cash flow analysis and then the relative valuations. This section is, I'll just call it, it's insufficient in and of itself, but it's the beginnings of that relative valuation section. So price to earnings, I think this data was pulled in for Boeing at one point in time. So when that data was pulled in, Boeing was trading at a price to earnings ratio of 24.55. Its 10-year average was 15.8. So what's that tell you about where Boeing was trading at the time? Looks expensive, right? If Boeing's an old, stodgy, blue chip, been around for 100 years type of company, where it has traded at historically is very meaningful to where it should be trading at now. It's not like a tech company that's going through a lot of mergers and acquisitions, and every time you look at it, it morphs into a different animal. This is pretty much the same company. So for Boeing to be trading at 24.55 when it typically trades at 15, that's very expensive. We need to know the reason why. Chances are, and I don't remember 2018, but chances are that for whatever reason, earnings were suppressed that year. Something happened. Boeing probably took a big charge. If I'm thinking back around to 2018, that was probably the big charge that they took on all those the delays they had in rolling out the 787. You may remember that. They had this huge 787 and they were extremely delayed. They had to credit back a bunch of the early pricing that they had given to some of those customers. They worked their way through it, but it was a debacle for Boeing there for I don't know how long. That could have suppressed earnings. So for a period of time, it might have been reasonable for Boeing to trade at that price to earnings threshold. In that instance, your job as an analyst is to come to some determination about whether or not that earnings shortfall is going to be short-lived. Can they bounce back from this? In which case that PE ratio is likely to go to 15 again next year. Or is it going to take some time for them to work their way through that issue? Because all of these research reports are formatted identically, I've trained myself to zero in on something like that almost immediately. I see these two numbers, and that's the process I go through in my head. So if this were your company, I'm going to see those two numbers side by side, and I'm going to expect you as the analyst to have addressed that in the executive summary section of your report. You know, why is that? Why is that company trading at almost twice as much as it has historically? And this section over here to the right should give you a little bit of an opportunity to just make some mention of that in your mispricing section. Earnings suppressed due to 787 rollout, likely to correct in the next 2 years. Stock looks undervalued. That's the type of commentary that I would expect to see on the front page with an expanded version of that in the executives. So you have half a dozen valuation measures on the front page, and we're looking at those today, relative to history, relative to peers. And you can find that data all over. If you do have a company that looks significantly different, if they have gone through a major merger, acquisition, divestiture, so on and so forth, you have the ability to change this column, this 10-year average number. Feel free to use a 5-year number or a 3-year number. It's your job to determine what's most appropriate and then defend it. So I use the 10-year number because it's Boeing. I use the 3-year number because my company went through a big acquisition 4 years ago. So anything prior to 4 years ago is less relevant. Okay, then I want you to break down return on equity. This takes us all the way back to module 3, I think it was. We did a big in-depth study analysis on the DuPont method. We broke that down by net margin, asset turnover, and total debt capitalization. Then we're going to look at the components of return on equity. Again, by current, historically, and relative to peers. And then I picked off, I'm cherry picking a couple of other metrics here that have been meaningful to this class: interest coverage ratio, gross margin, and EBITDA margin. And then obviously I want to see a in-depth ratio analysis in the body of your report. These are just the few ratios that I've promoted to the cover page because they give us some insights into how the companies function. So right here, we can see that, you know, Boeing's gross margin is 18.6. Its 10-year average is 19. So the cost of their goods sold is not the perpetrator. If you think of the reason, if you will, why their earnings are so low, we know right here it doesn't have anything to do with cost of goods sold. Their EBITDA margin is actually ahead of where it was of their 10-year average. So now we know that earnings before interest, taxes, depreciation, and amortization are normal. So there's got to be some charge below the EBITDA line that's causing those earnings to be depressed. So likely one time in nature. That's what I'm going to go looking for when I'm reading your reports. Okay, I think the rest of the section is pretty self-explanatory. 4M's, risk, challenges, conclusion. Give me the best possible conclusion that you can give me. I would recommend that you write and rewrite that 3 or 4 times, because that's immediately where my eyes are going to go. If you think that this company is, change that a little bit. Okay, if this is something that I should be buying, that we should be buying, put it right up here. Consider buy under 199. Give me a good rating. So the rating should be buy, hold, sell, the recent price, and the price target. And still want to know if you've bought this with your own money. If you're going to tell me to buy it, I'm going to take you seriously, and I'm going to read your reports like I would as a portfolio manager. And you were an analyst, which I deputized you all earlier in the semester to be my analysts. So I'm going to put some of these good ideas to work for my clients. And I want to know, yes, I took a small position with my own funds, or no, it wasn't quite that compelling. I didn't feel compelled to take a position. Maybe the stock's run up a little bit since you did your analysis. I want to know all that. Okay, so that's the cover page. Any questions on the cover page? Okay, I'm going to move on to the discounted cash flow analysis. So chapter 13, module 13, module 14 talks about a discounted cash flow analysis and a return on operating profit methodology. You can ignore the return on operating profit methodology for the purposes of the research report. There might be a question or two on the homework. I'd like for you to familiarize yourself with that. The authors go through a pretty substantive review / audit, tying the 2 measures back to one another. It's very well done. I need for everybody in this class to understand that both are equally valid. Again, for consistency reasons, I'm gonna use the discounted cash flow analysis. I'm gonna ask all of you to use the same for your research report. And that should look something like this. In module 11, we talked a little bit about the beginnings of forecasting. So at this point in the semester, you should have a firm grasp on where your company has been, and you should be beginning to forecast what likely sales, profit margins, earnings, ratios look like for 2023, 2024, 2025. And I want to see that for the next 10 years. When it comes to a discounted cash flow analysis, you can see here, I've taken a rather simplistic approach. This is available to you. Unless it's too simplistic. You're the analyst, you tell me. The authors of our book call this the parsimonious method. And to the extent that Boeing, in this case, has generated an EBIT margin of 6% for the last decade, well, that makes the forecast pretty easy. They're probably going to generate an EBIT margin of 6% for the next decade. So look back at what it's been. It's pretty consistent using. If you need to deviate from that, tell me why. I expect you to know. And I expect you to come strong and make a case about why you've chosen the margins that you've chosen. If you need to make any adjustments to the accounting, you can put those in the appendix, and when they're material, promote them up to the executive summary of the research report. So you can see here, this DCF starts with growth rate, pretty simple. Calculate the historical growth rate of your company. Compare that to management's commentary. In many instances, management's going to give you their forecast. You should, at this point in the semester, have come to some conclusion about whether or not you believe management. If they've historically been spot on with their forecasts, use that number. If historically they've been a little high or a little low or all over the board, maybe you look to some of the Wall Street research that you think is a little bit more authoritative. And just let me know why you use what you use. So you get growth rate. Last year's sales times this year's sales growth rate equals next year's sales. That's just a simple Excel formula where you drag that across. Then you're looking at historical margins. That revenue times margin equals EBIT. So that's earnings before interest and tax. Then you're going to have interest. Well, interest requires us to look at last year's debt outstanding. If management hasn't given you any indication that they intend to fundamentally restructure their debt, pay it off, borrow more, well then next year's interest is probably going to look a lot like last year's interest. Easy enough. Taxes, we talked about taxes before Thanksgiving break. You should have a table in the back of the 10K that gives you all of the information about taxes that you need. Make any adjustments for tax items that are one-time in nature. And if you don't have any adjustments for tax items that are one-time in nature, last year's effective tax rate probably going to be pretty close to this year's effective tax rate. Plug that into your spreadsheet. That gets you all the way down to net income. This is designed to focus, designed to generate net income growth. That calculates automatically. Shares outstanding, EPS, the multiple, those are all automatic calculations. And you can see that most of this just flows right on through to line number 20. You'll remember from your first finance class or your investing class that in order to calculate a discounted cash flow, we have to know what the cash flow is. Cash flow starts with cash. In order to identify cash, we have to discard any non-cash items. So by forecasting sales growth and by forecasting EBIT margins, we now know net income based on historicals. Let's add back the non-cash items, which start with depreciation and amortization. How are we going to forecast depreciation and amortization?
Historical trend we can see.
Historical trend, percent of sales, there's a lot of different ways that we could do it. Typically, Depreciation and amortization will fluctuate relative to property, plant, and equipment. Property, plant, and equipment changes relative to CapEx. So if your capital expenditures are fairly normal, like you're replacing your maintenance CapEx on an annual basis, here's a hack. I'm gonna oversimplify this for about half the class. If your company is like Boeing and they're not building any new facilities, maybe they're replacing the ones that are going out of order. So every 30, 40, 50 years, they have to build a new facility, but that's really just restructuring, replacing, replacement cost. Your CapEx over time should roughly match your depreciation over time. So you can take those two line items, depreciation and CapEx, which is line 20 and line 24. And you can roughly force them to be equal if your company is not growing. If your company is growing, then your CapEx has to be greater than your depreciation. And that's going to require some real work on your part, because you're going to have to do some digging into what management expects, what they're actually building, how much that costs, and what that time schedule looks like. And you're going to have to go in and discreetly put in the growth CapEx into each of these years. Working capital typically functions as a percent of sales. So you can set that as a percent of sales. If you look into this spreadsheet here, that working capital number is linked to another cell. And I think that is set up to calculate on a percent of sales. Yes. So if working capital is a percent of sales, it's going to grow at the sales growth rate. And that's exactly how the spreadsheet's been set up. Feel free to use that unless it's not appropriate, which is a consistent refrain in this class again. So then once you have working capital forecast, what we're concerned about in a discounted cash flow model is the change in working capital. So once we have made the investment in working capital, say that's $1 million, the difference between current assets and current liabilities, gets all our companies paid every pay period, establishes invoices, so on and so forth. We don't have to make that investment again unless the company grows. So it's only the change in working capital that requires additional investment on the company's part. It's that additional investment that's a drag on cash. So it's the change in working capital, line 22, that actually influences the operating cash flow. So if I come down here to operating cash flow, line 23, you'll see that's EBIT plus depreciation and amortization, less the change in working capital. And the only other line on this discounted cash flow analysis is the capital expenditure number, which takes you down to free cash flows to the firm. By the time we get to line 25, we have identified free cash flows to the firm. And then it just becomes a simple math problem. And all that math is programmed into these cells. So hopefully that'll be relatively user-friendly for you all. We're going to take the free cash flows to the firm in, this was year 2017, but call it year 2023. We're going to discount that back 1 year, or in the case of 2024, and you get the present value of all these free cash flows. Add that up, you get the present value to the firm on line 28, subtract debt, add back cash and short-term investments, back any outstanding lawsuits, options liability, pensions, non-operating assets. Boeing didn't have any of these. I don't know if your companies will or not. Take a look, put them in there in these cells if they do. That came up to 144 billion divided by diluted shares outstanding, and that equated to a present value per share of 238.81. This spreadsheet is set up to accommodate for a margin of safety after we do a discounted cash flow it's important that we recognize there's a lot of inputs on here that are very sensitive to the end result. You know, if we forecast a margin of 6% and it's actually 5.5%, that's not a very big difference, but it has a huge impact to our valuation. So once we get down to the bottom number on the spreadsheet, we apply a margin of safety that says, you know, we're not perfect analysts here. Let's discount this by 20% and say buy under 199. We think it's worth 238. Let's buy it under 199. That applies our margin of safety. Okay, that's a very quick overview of the cover page and the discounted cash flow analysis. Any questions on that before I move on to module 13 today?
Could you also look at margins of safety as the difference between the intrinsic value and whatever the market's paying?
I wouldn't define it like that. I would define intrinsic value as what the best of your analysis tells you that company is worth. If you had perfect data and if you had perfect foresight, you would know with certainty what a company is worth. That's the company's intrinsic value. We're going to compare the intrinsic value to the market value to let us know whether or not that's a buy or a sell. And then because there's no such thing as perfect data, and because there's no such thing as perfect foresight, we're going to discount our analysis by 20%. That's our margin of safety. So that margin of safety is the difference between your intrinsic value and
20%.
you can set that margin of safety at 20, 30, 40, whatever you're most comfortable with. And that's more of an art than a science, because some of you in this room will be more aggressive in creating your forecasts. Some people are just by nature more optimistic. Some people are just by nature more pessimistic. When I was working at the Buffalo Funds, I worked with 20 analysts that did this exact job, and I was one of them, and I covered Boeing. And I knew who on the team was more aggressive. You know, they came up with more buy recommendations to send to our portfolio manager. And that served them very, very well in a bull market because they looked like geniuses because everybody was going up and they were recommending that they buy everything. But when the market turned, it was the bears that had their day. And over time, you just gained some awareness for who was good at forecasting and who wasn't. My point is, if you're an aggressive forecaster, you might take that into consideration when you're applying your margin of safety and hold yourself accountable to a 25% threshold.
So based on your experience, that's an intriguing observation. Is there if you're gonna err on one side, is there in terms of forecasting, is it better to be more aggressive or less aggressive in your experience?
So when I was working for the Buffalo Funds, we had the time to do 3 forecasts because there's always several scenarios that could unfold. So limiting yourself to one is exactly that, a limiting factor. We would take a bull case scenario, what we call the base case scenario, where the base case was always your best guess. But then there's a bull case that can unfold for all of these companies. And a lot of times that looks like what management is telling you. Because you're typically gonna get an optimistic perspective from management. Very few management teams will tell you, next year is probably gonna suck. They're all gonna say, we're gonna have some challenges, but we have a well laid out plan. We've communicated to all of our employees and staff, and we intend to execute like this. And that's your bull case scenario. Some management teams can deliver on that. So you take a bull, you take a base, you take a bear case, you got 3 forecasts, then you probability weight those 3 forecasts. So maybe there's a 30% chance that this recession lasts and interest rate stocks like real estate and utilities and banking continue to be in the tank for another 18 to 36 months. There's a 30 to 50% chance that bear case could unfold for all 3 of those industries. Base case, maybe you have different macroeconomic assumptions. Base case, the economy rallies. We come out of this recession in the next 6 months. The Federal Reserve gains some control over inflation. And then bull cases, we're through this recession already. The Christmas rally takes us through it, and 2023 turns out to be a terrific. So I don't feel like I answered your question, but there's probably as many answers as there are analysts trying to predict the future, which is ultimately what we're trying to do. Okay. Let's move on to module 13, and I'll yap a little bit about cash flow based valuation, and then we can get out of here. Okay. Our authors are kind of walking us through various valuation techniques. Discounted cash flow is in this chapter, which is that's the most important for our purposes, because that's what we need to see in our research report. But there are, three different primary data points that we'll focus on, which are dividends, cash flows, and earnings. In a discounted cash flow model, we're discounting the cash flows, but you can do the same thing with dividends. You were all exposed to a dividend discount model. That was in last week's lecture, and it was also in your first investments class. Let's just take dividends, put a growth rate on that, and discount those back to time zero. Add up all the present values of those dividends. The theory there being that dividends are the only check we ever receive back to us as investors. So that's all we care about. That's a little bit more simplistic than a discounted cash flow analysis, because there are other ways we can get paid when that company sells to an acquirer, or when we sell that share price at some point in the future. That's why it's so important to have a handle on where that company actually trades relative to history. If you know what that range is, a lot of analysts make a lot of money buying a stock at the high end of that, selling a stock at the high end of that range, and buying a stock at the low end of that range. And I've made a lot of money doing that in the past. You familiarize yourself with some of these companies, and then you familiarize yourself with their trading patterns, and you know to buy Boeing at 15 times earnings and to sell Boeing at 25 times earnings. And if you look back at the last decade, you could have probably done that 6 times. And had you successfully executed that strategy, you probably beat the S&P pretty handily. Market multiples, earnings, book value, those are both on the cover page. You'll have an opportunity to look at your target companies, research companies relative to earnings, cash flow, book value, and so on and so forth. Terminology on slide number 4 here, our authors are pointing out everything that's fundamental to that discounted cash flow analysis. One of which is the horizon period. In the template that I give you all, it's a 10-year horizon. Now, asking any analyst to forecast the next 10 years for any company is an impossibility. That's a big stretch. Don't think I'm asking you to get down to that level of granularity. If you go out 10 years, all I'm really asking for, and all I really think is possible, is 1 or 2 periods of growth. If you have a relatively stable company that's growing like Boeing was at 6%-ish, well, you don't need 10 years. You could just take a 3-year forecast period and then put a terminal value on it. But for some other companies that are a little bit younger in their life cycle, they can grow in excess of GDP type rates. They can grow in excess of 6% for 3 years, 4 years, 5 years, 6 years. They can't do that forever, but a decade is long enough for you to forecast 2 different growth periods. A hyper or accelerated growth for the next 3 to 5 years, and then a steady state growth, or something that looks more like GDP type growth. So you should see that growth rate decline to something that looks more like GDP in a 10-year forecast period. In the terminal value, the assumption is that company has reached maturity and the financials should reflect what that company looks like at maturity. And primarily that's gonna leave us focusing on the growth rate. Now, what's a good growth rate for a company in its mature phase? Remember talking about this in your investments class?
2-3% maybe?
2-3%, that's the threshold, yes, the answer, that's the correct answer. It can vary, but the threshold has to be less than GDP. Because the terminal value is the assumption that we're making into perpetuity. And it has to be less than GDP. Otherwise, the assumption that we're making is that eventually, in a long enough time horizon, perpetuity is certainly a long enough time horizon, that company would outgrow global GDP. That company would consume every other company on the globe. So your growth rate has to be equal to or less than global GDP. Now, is that real GDP or nominal GDP? Well, it doesn't matter, but what does matter is that if you choose real, your discount rate has to be real. If you choose nominal, your discount rate has to be nominal. Most of the time in a discounted cash flow analysis, we're using a nominal discount rate, which would allow you to go up as high as like 5% on your terminal growth value. Okay, slides 1 through 6. I kind of gave away the punchline of all those when we were going through the Excel file, so I'm not going to hit you with that again. And then on slide 7, our authors begin a discussion of residual operating income, which they call ROPI. This takes us all the way back to module number 3, where we focused on the difference between net operating profit and then the margins that are associated with that. I'm not going to lecture on that because I don't expect you to include that in your research reports. Maybe a homework question on it, but I'm going to keep that brief so as not to confuse the issue tonight. Okay. I thought this was in the last module. I got a little confused. I mentioned that the Excel file that is on Canvas that we just looked at was based on the parsimonious method. This is the parsimonious method. And it takes you through the basic equation of focusing on sales growth with a margin that gets us down to either operating margin or EBITDA or net operating profit, depending upon which model that you're using. Okay, we didn't talk about weighted average cost of capital. The weighted average cost of capital was module 12. But here's a snapshot of how Procter & Gamble calculates their weighted average cost of capital. You need a little refresher. What we want to identify very quickly is the cost of debt. We're going to multiply that times 1 minus the tax rate to get an after-tax cost of debt. That's what we're primarily concerned with. And we're going to take that and multiply it by the percentage of debt on our balance sheet. And then to get a weighted average cost of capital, we're going to calculate the cost of equity, which Procter & Gamble identifies as 6.29. That's our basic capital asset pricing model equation where we're going to use beta and the stock's sensitivity to beta to tell us what the cost of equity is. So for Procter and Gamble, 6.29 is their cost of equity. 1.56 is their after-tax cost of debt. And then they have some preferred stock on here, but it's 0.3% of their total market cap. So we can just basically discard that. So if 88% of your company is equity and equity costs 6.29, 11% of your company is debt and debt costs us 1.56, our weighted average cost of capital becomes 5.83%. That's the number that we're going to use to discount all of our cash flows that you saw on that spreadsheet just a moment ago. Yes,
Is it correct that the preferred stock, or is it, the cost of that is supposed to be the, I guess, the dividend rate on there?
it's supposed to be.
Okay.
It
It says 28.3.
that says
So
28.34.
that's not,
I-
probably.
Well, here it is.
That just stood out to me.
The cost of, it's at the bottom of this, of the slide here. The cost of preferred stock is computed by dividing the dividends to preferred stockholders by the book value of the preferred stock. So.
Okay.
Yeah, at one. You gotta ask some questions about that. If I'm an analyst, then I'm on the phone with Procter and Gamble's investor relations department. I'm like, tell me about that preferred stock. How'd that get issued? What were the purposes? How long has it been outstanding? Is it publicly traded? Can I get me some of that? Because if it's yielding 28%, and there's a chance that it is, what you see oftentimes in these issues is that there's some covenant that was written into the language years and years ago that prevents Procter and Gamble from buying it back and just disposing it. So it's out there, but it's so thinly traded that no professional investor can buy it because maybe you can only get 10 shares of it at a time, which leaves the whole market open to retail investors like us. And you may actually be able to go out there and buy some of this that will yield 28%. Now I've done this with super thinly traded issues before, and you can, when it's that thin, when you're talking 28% yields, you're probably trading chunks of $10,000 or less. But I know a lot of students who'd love to make 28% on $10,000. I'd love to make 28% on $10,000. So yeah, that may exist. And if it does, go to that page of the 10K and tell me that's where you put your money for. Good point. Okay. This is a good table on slide number 17. It talks about that sensitivity analysis. So I had mentioned that one way to kind of get a grasp around the forecasting and how amorphous some of that is to create a bear case, a bull case, and a base case. Well, another way that you can get a handle on that forecasting sensitivity, or rather that discounted cash flow metric sensitivity, is to create a sensitivity table. And Excel will allow you to do this really easily. So that weighted average cost of capital is somewhat sensitive. We know that particularly the cost of equity is based on beta, and beta is not a pure estimate of anything. It's sensitive to your time horizon, sensitive to the market, whether or not it was a bull market or a bear market, so on and so forth. So we can say, okay, what happens to our price target if WACC fluctuates between 4% and 6%? And what happens to our price target if our terminal growth rate, which is another one of the more sensitive items, fluctuates between 1% and 3%? Well, a little table like this allows us to, quickly reference the report 6 months from now when all of your knowledge is starting to decay a little bit, and you're scratching your head and trying to remember your investment thesis. Well, you can come to a report like this and say, okay, well, maybe I'm questioning that terminal growth rate assumption. I had it at 2. Now I think it's going to be 1.5. Well, when I bought the stock, that terminal growth rate led me to a valuation of 104. If that starts to wane a little bit, maybe that stock's only worth 95. But fortunately, I had applied a good margin of safety and bought it at 80. So I'm still good. Okay, on slide 19, our authors talk about something called a mid-year adjustment. Discard that. It's technically correct, but again, I think we're getting into an area here where we're calling upon more precision than is actually possible. When I say it's technically correct, our authors are noting that the payoffs from the companies that we're analyzing in our spreadsheet show up as December 31st. When you go back and you look at that spreadsheet, the assumption is we're getting paid once a year, and that happens on December 31st. Obviously, that's not the way it really works. These companies make money every day. McDonald's sells hamburgers every day. Apple sells iPhones every day. So they collect money every day. So if you were going to do the math appropriately, you would make some assumption that discounts those cash flows back about a half a year instead of a full year. That's what a mid-year adjustment is. The reason I tell you to discard it is because I've never seen this used in practice. You just discount those cash flows all the way back to time zero. Your numbers are going to be a little bit smaller. That implies an element of conservatism. Good enough. Now, I have seen the second concept used in practice, and that might be a good opportunity for you to reverse engineer some of the assumptions that you've used, primarily WACC or terminal growth rate. So when we use a discounted cash flow analysis, it's our job to come up with assumptions for WACC, and it's our job to come up with assumptions for terminal growth rate so that we can calculate the intrinsic value. If you turn that on its head, we can say, what if the current price is the intrinsic value? What does that imply about the company's weighted average cost of capital or terminal growth rate? So we could say, for example, well, Boeing currently trades at 225. If that were its intrinsic value, it would imply a terminal growth rate of 4%. Okay, that's reasonable. That tells me that the stock's probably close to a fairly traded price at today's value. Alternatively, you could take that same reverse engineering concept and say to yourself, okay, Boeing's trading at 325. When I do the math on something like that, it would imply that their terminal growth rate is 7%. Well, we know that's broke. Boeing's not going to grow at a 7% number into perpetuity. That would imply that the stock is clearly overvalued. So it forces you to think a little bit differently about the numbers, what you're seeing, how you're analyzing them. It's a really good exercise to go. That's module 13, y'all. Okay, that's my lecture for tonight. We're done a little bit early. I am around for the next 3 weeks. I know that these research projects are long and they take a ton of work, and you have a third exam. So reach out to me. Let me know how I can help. If you have any questions, I'm going to try to make myself available. But you know, I've been out of the office for the last 11 days too, so I'm trying to catch up on about 500 unread emails. So reach out to me more than once, but you have my permission to bug. Anything else we need to cover before we adjourn?
Yeah, I was doing the dividend discount model yesterday, and my required rate of return, I guess was, I think it was lower than the growth rate or something, where it was causing the intrinsic value to become negative.
required rate of return. If you're using the dividend discount model, then your required rate of return is just gonna be your return on equity,
Cost of equity.
cost of equity.
Right.
Yep. And
So it was 7.43 and then I think the growth rate would be the growth rate for the
the dividend.
dividend, right? And it was like 8.5. So they have abnormally high growth rate for dividends, historical.
Yeah, I don't know how to write. Maybe I can do this. So in that instance, you're taking your dividend next year and you're divided by your cost of equity minus your growth rate.
Right.
K has to be greater than G,
Right.
or the whole thing breaks.
Right. I should be adjusting K, even though CAPM is telling me K is 7.43.
Or G, where are you getting your G?
Oh, historical averages, I guess. The
Okay, so
average dividend growth. I can adjust that, I guess.
yeah, you can adjust that too.
Okay.
And that's probably where you want to start. Because if they've historically been growing at 7%, that's an early life cycle company. That won't continue. As companies mature, that growth rate is gonna significantly slow. What company are you working on?
ACO. Well, it's been growing pretty steadily, like
Yeah.
consistently 8.5% under. So that's why I was concerned.
That's terrific. I would use a multi-stage model in that instance, so they do get credit for their growth. So take the dividend, grow it by 7-8% for the next 5 years, and then reduce it to 4 or 5.
Okay.
So this
Perpetuity.
this becomes your perpetuity value,
Right.
but you're also crediting the company for a higher growth phase, because you want to make sure they get credit for that, because
Understand.
that's where the value.
Okay, that makes sense.
All right, thanks all. Thanks Zoom crew.
So is there